every year we have several students coming to ask us for ideas for research. They have got to do their MBA research reports, and so Chris and I have listed a bunch of topics that we think are interesting. And some years ago, we put onto the list the FamaFrench 5-factor model. We wanted to find a student who was smart, who could have a look at that for us and compare it to the kind of style type analysis that we tend to have used. And so it took a while, but this last year we had a student, Tristan, who wanted to have a look at this. So I'm going to be taking you through some of what he found and how we've kind of extended this thinking a little bit more. So the first thing I want to just talk a little bit about, though, is the difference between the styles that Chris gets out of the style engine versus the Fama and French factors. Now, styles are what we've been looking at for a while, and what we do is we take the top 160 largest companies on the JSE and we put them into quintiles, 5 portfolios, equal weighted, based on the style that we're interested. So this might be size, for example, market cap or something like that. We rank them by market cap and then put them into a 32 into the top quintile, the next 32, and so on, all the way down to the 5th quintile, equally weight them, and we kind of rebalance those portfolios every quarter or whatever. The nice thing about this is we can handle sort of non-linear styles, such as interest cover. Obviously, companies can have too much debt or too little debt, so the optimal interest cover is going to be in the middle. So we can manage that. We can easily convert these things, and so there are some benefits to our methodology here. Now, the Fama-French factors are different. First of all, there's always a long minus short position here. So if you take size, for example, the Fama-French size factor takes small companies because they do better than large companies and shorts the large companies to fund the long. So the difference is you'd have to put, say, 100 Rand into one of our styles to see how it does. But there's no investment required with this methodology here. You've got the shorts, the stuff you're selling, the large companies funding the longs. So that's an interesting take on this. The other is that because these are shorted, and we've got longs and shorts here from the same sort of companies, it's going to be more or less market neutral, which is quite helpful. But one of the disadvantages here, which even Fama and French kind of deal with a bit, is that it's less concentrated because you've got the data is basically split in half. So just to illustrate all of this, here I'm demonstrating for you our style analysis, which we always present graphically here. In this case, starting from December 1987, we took all the top 160 companies listed then, ranked them in terms of earnings yield, the inverse of price to earnings, if you like, to measure their value versus growth characteristic, and put them into our portfolios. And then every quarter we rebalance these things, plot the results of the portfolios on a daily basis here. And you can see that the portfolio, which had consistently the highest earnings yield companies in it, shows a 21.8% average performance over this time frame that we're looking at over here. And you'll notice here's the second highest, third highest, and fourth, and this is the bottom portfolio over here. We also tend to show, this is the all-share index here, total return index here, somewhere in the middle. And you'll see we've done some price relatives here just to show you what the performance is doing against these benchmarks over time. Now, the Fama-French methodology would differ as follows. First of all, for value versus growth, they don't like to use earnings yield. They use the book to market ratio. Similar, but we find it not to be as good with our methodology here. And but this is what they use. And they split the sample into high book to market companies. And so the top half of the sample of 160 companies, in other words, all of these companies and this portfolio and half of this portfolio here, this quintile here, would be in the high one, giving an average of, let's say, 18.5% return. And then the low book to market portfolios will be the ones we've got here in 5 and 4 and half of 3, and that's giving 14.3, sort of on average somewhere over here. And that minus that, they report this statistic over here. 4.25% would be their factor for their book to market, their value versus growth factor, as they would call it. So with that in mind, let me show you what we did. First of all, here are the FamaFrench 5 factors. We've got the market risk premium, and this is the notation that they like to use, small minus big based on market cap. Value growth, this is the one we were talking about just now. They like to use book to market here, high minus low. Then there are two more newer ones. This is the based on operating profit margins here. Companies which are robust, have strong profit margins versus the ones ranked lower. They call this robust minus weak rather than high minus low, so it's not confused with this one over here. And the fifth factor that they look at is, and this has been found actually in lots of the literature, and we reported on this last year, in fact at SAFA, companies which don't invest much in capex versus those that do relative to their asset base here. So this is based on capex investment, if you like, and they call this conservative versus aggressive, and this is their factor for that. Now we went and took data from 1984 all the way up to the end of 2018. Top 160 companies, we did this monthly. We've included dividends and so on, make sure there's no survivorship bias in our data. And we fixed all corporate actions, share splits and so on over here. And we ran their 5 factors through our methodology, or their methodology in this instance here. And you can see we've got 29 years worth of data, and the first thing that strikes you here is this is the market risk premium, which most of us, when we're talking about the CAPM, would like to tell our students is close to 5 or 6% per annum. You can see we're finding it to be only 1%. That's largely because bonds did pretty well over the last 30 years. Then we have a problem over here because this is the small minus big factor on the JSE, and instead of it being positive, it's actually negative, minus 2% here. Lots of research has found that size is either not a factor, or if it is, it works inversely. That's what we're finding here. Big companies do better than small companies on the JSE. Then this is the value growth factor, which over this 29 years comes out almost 0. We do find, using their approach, this is robust minus weak, the profit margin here, a small positive factor here. The best one is coming from the investment, the capex. Companies which invest a little versus those which invest a lot as a percentage of their assets actually do about 3% per annum better. Now, there are problems with presenting the data in this form, and I want to show you them. If we show you what this looks like, these factors look like over the time frame here, you'll see some big issues. First of all, let's focus on the blue one here. This is small minus big, and you'll see that small companies did do better for about 10 years, and then they kind of didn't for the next 10 or 12 years, and then basically big companies did better than small companies, and so this ends up being negative over here. Similarly, this is looking at high minus low, so this is our value growth. You can see, in fact, growth did better, then value did better, and then basically nothing over here, and it ends up slightly negative. So here's robust minus weak. You can see that companies which had higher profit margins did better, and then they didn't, and then they did. And so it's very inconsistent yet. It's not, you can't really call these patterns styles. They're not consistent factors, really. The only one which has any possibility of being maybe a constant kind of slope here is the conservative minus aggressive. This is the CAPEX one. But even then you can see, well, for about the last 10, 12 years, it did nothing. And so having looked at all of this, we conclude as follows, that the FamaFrench 5-factor model is of little use on the JSE. We don't think you should be using it. And first of all, the factors are quite small. The things they say, like size, are not positive when they should be. And the trends are not consistent. They go up, then down, and so on. This is not what we're really looking for. So that's kind of what Tristan, our student, came to his conclusion about. But when Chris and I looked at this, it's obvious to us that, well, why don't we look at many of the other styles that we have looked at in our style analysis, and we've looked at a couple of hundred of these over time, and let's do them as factors, because we know, for example, that momentum and betas and other things work pretty well. And so we went and ran several of these styles, and I'm just summarizing some of the results that we found from that analysis over here. Here's momentum, for example, which did very well. This is almost 3 times what we find from the conservative minus aggressive investment style of FamaFrench, which was their best one here, coming in at 9.4%. This is just the benchmark of the all bond index, which we'll talk about again just now. Then here are the 2 others which do well. Earnings yield, we actually find this is better than the book to market, and it's quite good. And volatility is good, and then others less, not quite as good. If we plot the time series of these, you'll see as well that momentum, for example, it's pretty consistent. It's true, it hits some peaks and then falls off, as it has done in the last 3 years or so. But earnings yield also is okay. You could argue it didn't work very well for this period, but on the whole, it's done better here. And volatility, you know, these look a lot better. They're not, generally speaking, dipping into the negative territory here, then positive and negative and so on, as we saw with the FamaFrench factors here. So we preferred these. Now, have a look at the all bond index here for a moment. And you will notice that it does pretty well over this period here. And this is also pretty riskless. You can see there's not a lot of variance around this line over here, pretty solidly up all the way through. So we observed this when we first looked at this, and we found this interesting. We'll come to that in a bit more detail. Now, our next problem, of course, is we know that many of these factors, styles, are correlated amongst each other. And here you can see the correlation matrix with some of these, and you'll easily see, for example, that we've got some pretty high correlations. ROE happens to be very highly correlated with earnings yield, and volatility negatively correlated with market cap. So we ran a principal component analysis on all the styles that we thought were worth looking at, and we found that in just one component, the first principal component here explains 60% of the variance, which is pretty good. And then the second one, these are all orthogonal, so these are now representing different aspects. And we wanted to use the first 3, which would give us about 90% of the explained variance in the data. And when we studied the plots and so on, we thought that momentum best explained the first component. The second one was value and growth in the form of earnings yield. The third one was interest cover. But when we looked at interest cover, we realized we had a problem because a lot of financial services companies, banks and so on, interest cover is not a meaningful ratio for financial services companies. And it would have meant having to leave them out of our sample, and we didn't want to do that. So we dropped this one, and we just focused on these 2 here. And we, as I'll show you, still get pretty good results just with those 2. Now, our idea was to actually, because we saw that the all bond index did pretty well, we want to invest in the all bond index. We're going to put our money there because it's low risk and its returns are not that different from the all share index. I showed you earlier that the market beat this by about 1% per annum over the last 30 years. So it's maybe a good low risk place to start. But to get some juice out of the factors here, we're going to take the useful factors, and we're going to take the ones that have come out of our principal component analysis here, and we're going to use these to enhance the performance of our long all bond investment, if you like. And these, again, are self-funding, and these are market neutral, because we're using the FamaFrench factor methodology here. And we can always add some gearing to these factors. We haven't done this, but I'm just noting that we can. So we want to take, for example, 100 Rand, put it into the all bond index. Then we're simultaneously going to run 2 market neutral factor-based portfolios using momentum and earnings yield. And the beauty of these is that we're going to be able to make them self-funding. So we will sell the short portfolio, get the cash, and invest it in the long portfolio. It costs us nothing. And we can easily gear this up if we want to. We just sell 4 times more and buy 4 times more. It still costs us nothing. We do have to worry about some cover ratios, which I'll show you in a moment. Now, Fama and French, and we also observe that a lot of the useful information is actually in the tails of these distributions. So if you're looking at momentum, you're interested in the ones up here and the ones down here, but the middle stuff over here is not that useful. You saw that with the earnings yield graph that I showed you up front. So Fama and French also left out this portion in some of their studies. And we're going to then split the data like this. We're going to put this into our long portfolio here, this into our short portfolio. We're going to ignore the 40%, which is kind of in the middle of the distribution. So this gives us 9 possible combinations since we've got these 2 styles. They look like this. Here's momentum. We've got the high momentum shares, neutral, and low momentum. This is the 40% in the middle. Then similarly with earnings yield, we've got high, neutral, and low. And so for example, we take every single company at the beginning of the quarter and we see which of these portfolios it fits into. Here's Sasol. It can only go here because in the past quarter it was high momentum and it had high earnings yield. And then we look at MullerWard and it fits into this portfolio, and then Pick and Pay is in this one, and so on. Each company at the review period fits into one of these 9 portfolios that we've got here. And so on average, we're going to see about 17 companies in each one of these styles, if you like. And we've got these 9 portfolios that we can track. We're not interested in all of them, though, because for our long portfolios, we want everything which has got high momentum and high earnings yield. And so you can see that it's these ones I've shaded in green, and you'll notice I've shaded this one in dark green because this appears that these companies are going to be counted twice. Sasol, for example, is in this one because it's got high earnings yield, but it's also in the high momentum one. We do the same for the shorts, and I've shaded these in red here, and you can see that we've got, again, double the, this one's counted twice. Now, if these 2 sets of portfolios are going to be run together, and I'm showing what we effectively end up with here are 2 of, this one counts twice the weighting, and then we've got these 2 here. Similarly, twice the short weighting for low momentum and low earnings yield portfolio, and so on. Now, these ones in the corners here are actually cancelled out because we've got the same shares long and short. We don't need to look at those. This one we never looked at in any case, and this one simultaneously cancels itself out. So we end up with 6 style portfolios that we use, and we plot these. We work out their daily returns every day, and we rebalance them quarterly, and so on. And we're going to build our hedge fund based on this. So we're going to use those 6 time series and optimize them such that the Sharpe ratio is maximized for our portfolio. And we are going to limit the standard deviation of our portfolio to be the same as the all share index. We then also just must check that we haven't got too much debt in this fund. And so we monitor the cover ratio that we've got in our portfolio. And we do that as follows. All our investment in the all bond index counts as an asset. And so that is going to be given a small haircut of 5%. Our long portfolio gets a haircut of 15%, but that plus that divided by the shorts here must be above 1. And we just monitor that to make sure it's safe, if you like. So here are our results. Now, first of all, here is the all bond index. Remember, this is where we've got our money. We're starting in 1987. We put our 100 Rand into this portfolio over here. And at the end of that portfolio, it's worth 430 Rand. Sorry, 4,300. We start with 1 Rand up to 43 Rand over here. But we have also been able to get the benefits of our 2 factors that we are running in terms of our hedge fund as well over here. And that has taken us from this performance down here up to our unit trust, our unit hedge fund. This is our hedge fund, which is running here in the background, showing you how that would have done. And I'm also showing here, this is the positive minus negative momentum, a factor that we're using, and the high minus low factor that we're using. And you can see these factors work pretty well. They're pretty consistently upwards here, much better than the FamaFrench stuff that we saw earlier over here. And so we think this is a pretty good result. And just summarizing the returns over this 29-year period or thereabouts, you can see our hedge fund came in at about 37% annualized return. That's based on our cash here, which gave us about 13% per annum, but we're getting some benefit out of our market neutral momentum and earnings yield based long short portfolios. This is our benchmark here, the all share total return index here, because we've matched the standard deviation. Our fund is as risky as this one, but a much higher return. So we like that. Just to show you what the cover ratio looked like over this period, just showing it in each quarter here, you can see that the lowest one we had was over here, and it came in at about 2.4 times, and this is our limit down here. So we could easily gear this fund up. We haven't included any gearing here, gearing level of 1 actually in this. So summarizing our results, with 1 times gearing in our 2 factors, our average cover ratio is about 2.7 times. The lowest we got was 2.4. Hedge fund return about 37%. The beta of our hedge fund is also very low. It comes in at about 0.3, and the R squared against the all share index is only 11%. So this is a pretty low risk return without gearing, and well, with very little gearing. Now, just some criticisms before you give them to me. First of all, we're very aware that what we've done is in sample. Just to return to this graph here, you will see that this hedge fund does really well in the first half of the data and then kind of drops off in the second half. And if you were to just like take the last 3 years, well, you would argue it hasn't worked at all. And we are kind of just using all of this data, sort of, it's an in-data type model, and we are aware that that's a fairly big problem. And but nevertheless, we still think there's some juice in this. So we're also able to increase the gearing, which we think will help a bit. We haven't included transaction costs, and there will be some transaction costs because we will be moving shares every quarter between our long and short portfolios to run this to run our hedge funds. And there's obviously some concentration bias in that we've got 2 weightings of some of these portfolios. SASL might be in our portfolio twice, for example, on either the short side or the long side, and so on. So that might cause some problems. And just a side note to say, it would make life a bit easier for us if someone were to have some factor-based ETFs out there, momentum and value growth, which would enable us to easily run the hedge fund side of this. That's it. Hopefully that was useful. Thank you very much.